Okay, hi everybody. I hope you can hear me. Yes. Um, so last week, I think Sir completed with the last session, and I will progress into income from other sources. For today, we have section 56, and we have a case which is the Ranjan Pai, PCIT versus Ranjan Pai. So these are the two essential things that we are going to do for this session. And we will start off with just discussing what you had for your formative exam. And it was an MCQ. So I'm guessing it was mostly direct questions, and I'm hoping that you have understood through the paper what exactly we are actually looking for, or we might ask you. So let me give you an overview. Since it was mostly a hypothetical questions that was given to you, you were giving MCQs, four options. Along from those four options, one is correct. You choose from it. For your summative, it will be slightly different, where we will give you that particular hypothetical question, very similar to what you saw in your formative exam. But what we ask you from these hypothetical questions will be much broader. It will be say 10 marks or 15 marks. So you'd have to write down what your thoughts are, what your arguments are, support your arguments with the cases. So if you had a good look through what our formative questions were, it was mostly through all the cases, questions um, that we have taught in class or that was there in your reading materials, all uploaded on the LMS. So if you had actually gone through the reading materials, the LMS, the PPTs, and the classes, you would have done pretty well throughout your formative exam. So, exactly this is what we are looking for. We will look for proper arguments that is backed by the cases that we have also based the hypotheticals on. So, I'll just go through all the MCQs, all the hypothetical questions for the first few minutes of the class, and then we'll go into the income from other sources part. So, essentially, today's class, has not a lot of uh, mm, elements of income from other sources because it's just one section and one case. So, it won't take a lot of time for today. I think 1.5 hours, probably by one, I'll be done, and after that we can take questions after I'm done with everything. And yes, so we'll go through the formative exam for now. Okay. Yes, so this is the first question. This was primarily based on, if you had a read through your reading materials, it was based on Shirin Bai Kuka as well as Kika Bhai Premchand, an amalgamation of these two cases. So if you have read these two cases, you will know exactly what to answer. So Rohan Kapoor is a sole proprietor engaged in the business of trading in previous precious stones. His accounts are maintained on the mercantile system. Apart from his business, Rohan also holds 50 diamonds as personal investments, which he had purchased in 2015 at 20,000 per diamond. On April 2022, when the market value of each diamond was 75,000, Rohan decided to bring these investment diamonds into his trading business as stock in trade without any sale or transfer. In this business books, he recorded the diamonds at their market value on that particular date. In January 2023, Rohan sold all the diamonds to an unrelated buyer at 80,000 per diamond. During the assessment, the income tax department contends that Rohan incorrectly adopted the market value as per April 2022 as the cost of diamonds for computing business profits. Assume that no statutory deeming provision applies, and you have 5 questions on it, right? So the first question is, what should be taken as the cost of diamonds for computing Rohan's business? This is B, which is 75,000 per diamond. Very simple. If you look at both Shirin Bai Koka and Kika Bai Premchand, the basic two principles of the case were, well, one, no taxable profit when dealing with himself. When you're dealing with oneself, there is no income. That is sorted. And second, capital assets, when introduced into the business stock in trade, it will be sold as actual cost, right? So 75,000 per diamond. Second, what best describes the reason why the revenue might oppose the valuation of the diamonds and market value? So, this particular question, we just wanted to have a look whether you also ascertained, you also studied what is the other side of the argument, right? So, B becomes because income tax laws ignores the principles of commercial trade when one is trading with oneself. This is essentially what both the cases Shirin by Kabai Premchand actually talks about. Well, you also have to kind of look through the first case, which was on um, the first rule, which was on, I forgot the case name. The English case. Does anybody remember the English case that Sir had taught? I forgot the name of it. Wait, let me just have a look at it. If anybody remembers, can anybody just remind me of it? Anybody? Hmm.
Arki versus Werner case, ma'am.
Yes, the Werner case, right. So this, if you also have a read about it, you will also get a very good basic understanding of what we wanted through the essentially all this questions that we were asking. The third question, which principle is central to both Kikabai Premchand and the dissenting opinion in Shin by Kuka that is necessary to be taken in the aforementioned scenario? It's D. Person cannot make taxable profit by trading with themselves. So these two, anyway, I've given you the overall view that what Kikabai and Shinbai is, and we have just asked very direct question based on the hypothetical from it. Fourth question, according to the reasoning in Kikabai Premchand and the dissenting opinion in Shirinbai Kuka, how should the distinction between withdrawal of stock in trade from businesses and introduction of personal assets into businesses be understood for income tax purposes? B is largely artificial as both situations involve valuation adjustments within the same economic entity. The last question in this particular set is if this provision applies to Rohan Kapoor's case, as in the first, the other situation that we were talking about, which of the following is the correct legal consequence? So, what is your provision? Essentially, this is what the parliament has come up with right now. So, we just gave you that. We gave you the question based on the fact that, okay, we don't have that provision. Now, what if the provision is back again? So, you know what the provision is where capital asset is converted into stock in trade, such conversion shall be deemed to be a transfer, and the fair market value of the asset on that date of conversion shall be deemed to be the full value of consideration for purpose of computation of income, right? So this is B, which is the appreciation up to date of conversion becomes taxable by operation of the statutory fiction notwithstanding Hika by Premchand. Okay, so yes, this is the next set of questions. Okay, so if you give a read of this particular question, it's mostly based on Mahindra and Mahindra, right? So I think Mahindra and Mahindra and also Alembic. Alembic is not a case that we did, but it's also a provision that we kind of like most of these type of cases actually reverted to or took in account of. So if you know Alembic also, you had an idea of how to approach this case. So the first question is, which of the following, sorry, just give it a read. Zenith Limited is engaged in the manufacture of consumer electronic goods. In the financial year 2018 to 19, it obtained a loan of 6 crores from a public sector bank. 4 crores of the loan was used for purchase of plant and machinery. 2 crores was used to purchase an office building. Interest paid on the loan was claimed as deduction in earlier assessment years. Due to financial distress, Zenith entered into a one-time settlement with the bank in the financial year 2024 to 2025. Under the settlement, 1.8 crores of the principal loan amount was waived. 70 lakhs of outstanding interest was also waived. In its return of income, Zenith 1 offered the waived interest of 70 lakhs to tax. Second, did not offer any portion of the waived principal amount to tax, contending that loan waiver is a capital receipt. The assessing officer proposes to tax the entire waived principal amount as business income. So, essentially, a loan waiver question, very similar to Mahindra and Mahindra, some amount of parts you could take from Alembic. So, in this particular case, the loan has been used for major purpose of the loan is used for capital purposes. So it's a capital receipt anyway. And when we look at the first question, which of the following best reflects the current tax treatment of the waived amount? So firstly, it's D, which is it is capital receipt not chargeable to tax since the loan was used to acquire a capital asset, as I said. Second, what is the primary factor that determines if a waived loan constitutes taxable income? B, the original purpose for which the loan was obtained. Obviously, you look at the original purpose of the loan when a loan has been taken. So whether it's revenue receipt or whether it's capital receipt, it's if it's a capital receipt, whether there is an enduring benefit. Obviously, in any type of capital receipt, you will have an enduring benefit, and that's why it is. Okay. Yes. So second one has been done. Third question. What is the central principle established in the TV Sundaraman Iyengar Sons Limited case regarding the nature of receipts? This is C. A receipt initially of a capital nature can change its character to a trading receipt due to later events. Right? This is very simple. You can just give it a read. If you've not understood, then it's Sundaraman Iyengar case. You just go through it and you'll understand. Most of these are very basic questions, I feel. This is probably, yes, this is the fourth question. Why is the waived interest amount of 70 lakhs taxable? It's D, because interest had been allowed as a deduction earlier and its remittance attracts section 41(1). Right? It's part of both the cases. I think TV Sundaraman, no, this was the dissenting at TV Sundaraman. I think it was mostly with um, Mahindra and Mahindra. Yes. Yeah. What is the best answer to the question whether Zenith is taxable because of recent amendments to the section 28 of the ITA? This is the last option, which is D, might be taxable as a prerequisite under section 28. Right? This is your third hypothetical question. As far as I remember, your third hypothetical question was mostly based on smart chemtech, on non-compete clauses, whether non-compete fees amounts that were given to a company are taxable or not, right? So your first question that will come into your mind is whether non-compete is a capital receipt or a revenue receipt. Okay. In order to understand that, you will have to answer whether it's an enduring benefit or it's not an enduring benefit, right? So in itself, non-compete clause, since it creates an enduring benefit for a business, it helps the business to run itself. It is a payment capital in nature, right? So considering that in mind, the smart chem tech and the enduring benefit test, we move forward to the questions, right? So the first question is, which of the following are relevant tests to determine whether the non-compete fee paid is capital or revenue in nature? This is your third option, which is whether the payment helped in facilitation of trading operations. Your second question for this is, if a certain amount was used by CP on the maintenance of its plant and machinery, what would be the tax treatment of this expenditure B, under the Income Tax Act, is the second question, second option, which is revenue expenditure whose purpose is to maintain or operate the existing structure. Hence, it would be deductible, right? Um, so as I said, the enduring benefit test is important here. So according to the enduring benefit test, as interpreted by the courts, which is when is an expenditure that provides a long-term advantage classified as revenue expenditure rather than a capital expenditure. This is your when the expenditure facilitates trading operations or increases efficiency while leaving the fixed capital untouched. Yes. Your this is your yes. Yes. If the non-compete agreement had permanently restrained DP from competing without any time limit, the best answer to the question, what is the tax treatment of the payment in the hands of CP, would be it is a capital expenditure due to acquisition of any type of permanent rights. The non-compete acts as a permanent right here, where you ask another business not to operate at a certain market, certain with certain customers, or certain limitation of certain products. So you acquire a certain amount of right, you acquire a certain amount of enduring benefit. This is your last question from the CP question, which is which of the following factors would most strongly support the argument that the non-compete fee was revenue expenditure? The first one, the fee increased the profits of assessee without the creation of anything that endures like an asset. Right? Okay. We move forward with the last question. Four questions, five um, sub questions, so total of 20 questions for you. This question is mostly based on Subhash Kabini, Maheshwari Mills, and if you have given read to both these cases, very simple, and I don't think any question was asked um, which was not told to you or talked about in the reading materials or in the classes, right? Um, so, Green Flow Energy is a company engaged in the business of generating electricity through a hydropower project. In the course of operating its project, the company adopted environmental efficient practices resulting in reduced carbon emissions. Under the Kyoto Protocol mechanism, Green Flow Energy was allotted carbon credits which were certified by an international agency. During the relevant assessment year, Green Flow Energy sold a portion of its surplus carbon credits to a foreign company for 3 crore. The carbon credits were reflected separately in the records and were transferable entitlements. The assessing officer sought to tax the receipt as business income under Section 28, contending that the credits arose due to the company's power generation activity. Green Flow Energy contends that the receipt is a capital receipt and not taxable. Assume that no statutory provision applied to this scenario. Can anybody tell me what statutory provision does apply from the Income Tax Act? Yes? Anybody? Yes. It is right. Dirgesh, section 115 BBG. Exactly. If we had not given you this statement that no statutory provisions apply to this scenario, sections 115 BBG would apply to this particular scenario. But when it does not, we will go forward with that question. Okay. Which of the following best captures the decisive legal test for determining whether proceeds from the sale of carbon credits are taxable as business income? This is question B. Whether the carbon credits arise as an incident of trading operations or as an independent capital entitlement rooted in environmental regulation. Okay. Uh, Next question. What's the best answer to the question whether carbon credit receipts could be held as outside the scope of Section 28? The last question is D. The receipt did not rise from carrying on business or exercising a profession. Next question is, if the revenue were to argue that carbon credits were subject to capital gains taxation, what would be the best response to this argument? So first, A, not taxable as there is no transfer under the ITA, right? Next question is, which proposition regarding business income can be considered as common to both Maheshwari Devi Jute Mills and Subhash Kabini Power Corporation? This is B. Transfer of statutory or regulatory entitlement does not constitute income merely because it is monetizable. Right? Lastly, based on your analysis, Um, was anybody trying to say anything? Because I can hear somebody talk, but I cannot understand because that person is breaking out. So, if you have any questions and I can't hear you, you can just drop it down on the chat box and I can have a look after we have completed. Okay? Yes. This is your last question. Based on your analysis of Subhash Kabani and Maheshwari Devi Jute Mills, did the judges have a definitive view of the definition of income under Section 224 of Income Tax Act? This is your B. The judges were mainly concerned with the question of revenue receipts versus capital receipts within the business income schedule. Okay. So this is essentially your question, your answers to the questions. Um, and what you had gone through for your formative exam. I am hoping you understood what exactly we are looking for at NLS when we are questioning you about anything. So, majority of the time, what we do is we will give you a question related to what you have already done in class or you have read in your reading materials. A lot of times we club two or three essential cases from a particular area, club it together and ask you questions. So this is essentially what we are looking for, just for you to understand a particular case, what major principles that case applies, what kind of sections that cases are looking for, and in your answer, obviously when you're writing, you have to mention the cases, you have to mention those cases that we are primarily looking for. When you read the hypotheticals, you will understand what type of cases it is based on. Those are the essential things that we are looking for, right? um I'll give you 5 minutes and 2 to 3 minutes actually, and just if you have any questions you can just let me know. Okay.
Ma'am, when will result will come out of this formative assessment?
That you'll have to ask Pace. I'm not really sure about it. So you just can send
And
email.
ma'am, and if anyone like me have not qualified in this formative assessment, what is the way, whether any chance will be given?
I mean, you won't have a second chance for a formative exam. You will have to compensate it for in the summative exam, which is the written exam. And if you cannot pass, then you'll have to give a supplement exam again. I'm sorry, HP, you're kind of breaking out. Like I can't hear you properly.
Ma'am, if I do not qualify in summative examination also in June, so
Yes.
then I have to write again for both the examination, formative and summative in
No,
December.
then you'll have a supplement paper.
Okay.
Separate supplement paper will happen. Now, if you cannot qualify for that supplement paper also, then you'll have to give the course again. You have to do the course again. Okay. Anybody else who has a question? Um, Even if you want to write your question on the chat box. We'll give you another minute. If I don't get any questions, then we'll move forward. Okay. Okay. Since nobody has any questions, we will move forward with the class and the sessions. Mm, one second. Okay. So today's session is on basically section 56, which is on income from other sources, right? So I'll just share my PPT 1 second. Just give me 1 second, I can't find. Okay. I hope you can see the PPT. So this is income from other sources. Mm, Essentially, section 56 as a whole. Section 56 is nothing but a residuary section or an umbrella section that we call. Umbrella clause we call mostly in mergers and acquisitions clauses, but when it comes to taxation or any other provisions, be it constitution, we consider these type of clauses as residuary sections. Residuary sections, can anybody tell me what essentially residuary sections mean? Anybody?
I think which where income cannot be accounted for in any other head, it's taken under.
I'm so sorry, Asha, you are kind of breaking out. I'm unable to understand what you're saying.
Ma'am, where the income cannot be accounted for in any other head, it is taken under is a residuary head.
Yes, very good. So essentially, you have a particular income coming in, which probably falls in salary, will come in the salary, heads of salary. Some income that comes under house property will come under house property. Some income that comes under business profession or capital gains will come under those particular sections. But certain certain um, incomes may not come under any of these heads. So, what do you do with it? You essentially put it under section 56, right? So, it kind of engulfs all necessary incomes that may come or may arise in a particular financial year. So, the question arises is what type of incomes are these? Like, what else could you gather more than business profession or capital gains or salary? What else? So, one of the major income being gifts. Gifts are considered, if you are gifting somebody anything that exceeds 50,000 is on a flat rate 30% tax, right? Falls under 30% tax bracket. Anything above 50,000. Other things are lotteries, races, card games, any type of such activities that you are doing and you win something, you end up uh, considering as that being considered as income from other sources. Another thing that is um, interest income, which comes from savings or fixed deposits. That also ends up being a part of your income from other sources. The last thing that comes to my mind is dividend income. Previously, the dividend income came under something called a DTD, which is essentially the dividend distribution tax. But the government now has kind of abolished the dividend distribution tax, and dividends fall under your overall income, which comes under section 56. Yeah. So this slide kind of gives you like a small summary as to what section 56 is. I've also given you this last slide where what type of incomes are taxable under this section. Okay. Now, there's a very interesting section or a part to note for in section 56. Very interesting question of law, actually, is the fact on angel taxation. Angel taxation has been abolished right now, but section 56 7A and section 56 7B, these two provisions are mostly on angel funding and venture capital, and how these are essentially a part of um, the tax regime, or how they are taxable, right? Previously, when you look at section 56 7A, there are two scenarios that arises. The first scenario being, wait, I'll just pull up the, yeah, I'll just show you the question, sorry, the section on this one. Yes, this is essentially your section, right? This is 7A and this is 7B. So when you give it a read, it says, where a firm or a company, not being a company in which public are substantially interested. So which means that a company which is essentially a startup and uses private placement as an option for their shares, capital, or everything. Okay. Receives in any previous year from any person or persons on or after 1st day of June 2010 any property being shares of a company, not being a company in which the public are interested, first without consideration, and second for a consideration which is less than the aggregate fair market value of the property. So the first scenario gives you an understanding what happens when um, typically an investor invests in a particular startup, which where they are probably investors, but they don't invest, but they are probably take certain amount of other rights. Maybe just a confidence in your startup. Keep okay, your startup will grow a lot. You have a confidence on your startup, and so they kind of like want to be a part of it and take a certain amount of shares from you, or for a consideration less than a market value. Very similar to the first scenario itself. In both these scenario, why why do you want to even tax a certain regime like this? Can you tell me why that happens? Because here essentially you're not creating any wealth, not for the startup, because nothing is being bought, but from the investor's side, how is it an income or how is it in wealth? Can anybody think about maybe the legislative intent or legislative perspective on these clauses? If you have an understanding, I'll give you a minute, but yeah, if anybody can.
Madam, what's your question exactly?
Okay, so when you read 7A, you see that you are investing in a company, but in could be investing in a startup, could be investing in a company, but you don't give a certain amount of money to the startup, right? Or you are buying a certain amount of shares which is less than the aggregate fair market value. Why is it happening, or why would that be taxable anyway? Okay. Anyway, I will go forward with it. The major part of this provision was angel taxation. Angel funds are essentially when pre-seed money which is given to you before your fund before your company has even started making profits. So essentially your firm is not your startup, your firm is not what you call as a highly profitable um company, but it may have the potential of doing it, right? So when there is a potential, an investor looks at the potential, the confidence on the firm that yes, probably in the next few years this firm will grow to a large extent, so I just want to invest on it. And they take a certain amount of shares just by giving their probably say their know-how, say they know a lot about how you should approach the market, how you should approach the customers, and so they are now a part of your investment cycle and they want to be a part of your company. So this whole taxation was done in order to evade certain amount of tax evasion structures. A lot of times it may happen so that an investor is just investing in a fund to kind of maybe evade a certain amount of tax, right? So this particular um, section is like an anti-abuse provision, which you'll also see in the case of TCIT versus Ranjan Pai when a bonus share is issued by a company. Very similar to these particular scenarios. Mostly, a lot of times, income from other sources are scrutinized to a lot of level because the income tax looks at it as you're trying to abuse tax policy, you're trying to abuse tax provisions, or you're trying to evade a certain amount of policy, tax policy. And that's why these provisions also act as an anti-abuse provision, right? So the second part of this 7B is essentially the same, which only talks about venture capital. The first part being angel taxation, angel funds, and the second part being your venture capital. Second part, you will see that any consideration for issue of shares that exceeds the face value. Now, this is a stage where you would be taxed because you are investing in a company and you're paying a certain amount of premium. You're not with going without consideration, but you're paying another premium. When you are paying the premium for the company, it's profit anyway, it's an income, it's a wealth. So this would come under taxable slabs, it would be taxable, right? So these two provisions are mostly anti-abuse provisions that we see under section 56. Okay. Moving forward, we see sections on gifts, sections on Hindu undivided families. Um, a lot of them talks about movable and immovable properties and how they should be assessed. Not all of these are important, but just have an overall idea of what exactly um, of what provisions are important. As I said, the fact that you are getting interests from particular savings or a fixed deposits, maybe certain gifts are being given to a particular party which exceeds 50,000. Fourthly, maybe certain amount of shares that are being bought over the fair market value or under the fair market value. What type of devices are being used there? But this particular section about the devices being used to evade taxes will be more mm, appropriately scrutinized at a later stage in the sessions when you go through actually tax avoidance, general anti-avoidance rules. We would do that at a later session. These provisions are where you would actually understand how these provisions work, how section 56 7A 7B work. Okay, so for now we understand that these provisions essentially help firstly to ascertain as to what taxes are not, what income has not yet been taxed and would be put under section 56. Second, a means or a device to kind of yes, Asha, you can go forward with your question.
Ma'am, in case of amounts above 50,000, it is the recipient who will be taxed or the one who invests will be taxed? It is the recipient, no?
Recipient, yes, of
Yeah.
course.
Uh,
Yeah.
I just wanted to clarify because, we are talking about investment in some startup and all that, no? That is why.
Yeah. So you have to understand who gets the wealth,
Yeah.
ascertains the income is being ascertained by who, the startup or the person who's getting a gift. Those
Okay.
people are going to be taxed. They are accruing the wealth.
Uh,
That's your first basic 101 of taxation. Then whatever income is accrued to you or to the person. When I'm
uh.
losing money, why will I be taxed?
No, ma'am. What when we understand it from the tax avoidance point of view, the person who is investing there could be trying
That's a very
to.
different aspect altogether. When a tax avoidance issue comes to your table, you do not
Yes.
only look at it from a point of view as who is receiving the money, you have to also look at it from the point of view of who is giving you the money and why is that person giving you the money.
Okay.
That's a very different issue that will come up. But
Okay.
these are the basic first hand anti abuse provisions that were created even before general anti avoidance came into being. That's what I'm trying to tell you, that these
Oh.
were the
Oh.
start point of tax avoidance. So yeah, so essentially this is what happens in your um section 56. Angel taxation that I was talking about, which was an anti-abuse provision, has now been completely abolished in the finance bill for 2024. It's no more there. Essentially now if you do invest in a startup, it would come under, it would be scrutinized separately. Okay, maybe under general anti-avoidance, maybe. So that's a separate provision altogether. Now, wait, I'll share the screen again. Yes. So we went through section 56, what the basics are. We'll move into a very important case, which is Income Tax Commissioner versus Ranjan Pai. Now, when we talk about this case, a few um, questions come into mind. Is how the income tax is actually taxing um, a lot of um, income from other sources consideration. Okay, how they are actually going through the process. The first part is okay, I'll just go through the facts and then we'll come to the issue. That will be more easier. So what happened in PCIT versus Ranjan Pai is that firstly, Ranjan Pai was a medical professional. He went on declaring that he had a certain amount of tax liability for a year, which was around 3 crores, 2 or 3 crores. Okay. Now, what happened is the income tax department started scrutinizing his accounts. They found out that his actual income was 12 crores. So, a lot of undisclosed income had gone into, and he had not even paid, he had not given that to the income tax department. A part of this 12 crore was bonus shares. 1 crore worth of bonus shares. Okay. Now, the bonus shares that were here was under the main contention. Like the main issue arises from the issuance of these bonus shares. Um, so what is bonus shares? Can anybody tell me what is bonus shares?
Ma'am, share has been distributed in lieu of dividend.
And anything else? In very simple terms, bonus shares are additional shares that are given to shareholders. It can be in lieu of dividend, it can be in lieu of profits. Certain amount of profits, a certain amount of reserves have been given, have been ascertained by the company. That company kind of converts these into shares and gives it to its own shareholders without a price. Like you don't have to pay amount, it's just bonus shares. It's just extra shares that you receive from the company, and it does not really it does not really come from, it does not give you an income. Essentially, it's just reallocation of the funds of the company into shares. Okay. So these increases the number of shares in the hands of your shareholders, but essentially it does not have a lot of investment value. Now, why doesn't it not have a lot of investment value? Because when you receive a certain amount of bonus shares, most of the economics of shares, if you look at whichever company has given out bonus shares to its shareholders, the amount of the shares actually fall. It actually decreases. So when it decreases, essentially the value of your shares also decreases. So it doesn't really add up to an income. It is just a way of showing loyalty towards their own shareholders. A company showing loyalty towards their shareholders, that okay, you are the first one who I would give my bonus shares to, right? So the bonus shares does not involve any release of profits, and it cannot be charged under section 56(7). This was what the Commissioner of Income Tax Appeals had told in the first instance, the first time the case went up to the commissioner. They said that there is no profits, it's just shares that are being issued to the shareholders, and they cannot be charged under section 56. The ITAT, when the appeal went to the ITAT, they also had the same notion just as the High Court. Sorry, not the High Court, the CIT, right? CIT and ITAT both say that no, section 56 will not come into place here. It cannot be charged because there is no realization of income as such. You buy the shares, even when it comes from the company, it is essentially reallocation of reserves of funds or any type of profits that the company is earning, right? So, in order to understand this in a broader sense, we will go through two aspects of law that the High Court had ascertained in this particular case. The first being is, what is the difference between creation of shares and the transfer of shares? Okay. Now, when you look at the case, Ranjan Pai, um, the shares that were given to Ranjan Pai or any other shareholders were new shares that were created. There was actually no transfer of property. So essentially, in any type of company law, we see that there is a very big saying, I would say, that shares do not exist until they are allotted to somebody. So if a share is allotted to me, only when I'm paying the money will the share come in existence, right? I say that a particular share is 10 rupees and then I don't give it to anybody. That 10 rupees has no value unless and until I buy it, right? So it's only given to a person, allotted to a person, that person gives the money, then that share has value. Then that share goes up or down according to different externalities of the market, right? So the bonus shares is essentially creation in the hands of the allottee, right? You are giving the share to Ranjan Pai. He is getting the share, the bonus share, which is created by the company. This is not a transfer of property as such happening, right? Transfer of property will only happen if Ranjan Pai, who gets the bonus share, now gives it to XYZ. That is where the income would happen. That is where there is a realization of profits or realization of income, right? Thirdly, as I said, it was merely a reallocation of company funds that were happening. Okay. It was like the company took some amount from the funds, made it as shares, gave it to its shareholders. That's it. Creation of new shares. That's it. And lastly, a company cannot hold its own shares, right? Thus, it has to transfer them. But in traditional sense, this transfer is not happening here. It's just creation of shares, which is essentially given to a shareholder, right? Now, when we look at how does the High Court interpret Section 56 in this particular case? When you look at Section 56, subclause 2, subclause 7, very similar to 7A and B, it has two parts. Okay. So the first part is property received without consideration and property received for a value less than the fair market value, right? Here, what was happening? Bonus shares was received less than the fair market value, right? The fair market value of shares was probably 100 rupees, and the bonus shares was received by shareholders for 50 rupees. Say, I'm giving you an example, right? So, there is here what is happening is there is no accrued benefit, or any real benefit is also not arising here, right? For the company, as I said, that um when you are actually given new shares, the market value of the original shares actually goes down, right? So the bonus shares are just given to the shareholders without any money. So essentially, when you increase the number of shares, so it's an economic concept though, but just consider it as a very economic point of view that you're increasing the number of products, and then you are selling a certain amount of product to a person without any value, then the overall price of that product will go down. That's an economic point of view, very similar to what is happening here, right? The shares is certain to make more shares, and you sell this amount of shares to a person without any value. So the overall price of those shares will shrink. So when it's shrinking, essentially there is no income that is being realized by Ranjan Pai. And so what the High Court of Karnataka is saying is here that this particular event of issuance of bonus shares is a neutral event. There is no income being realized, there is no income being lost. Nothing is happening here. The only thing that is happening is, first, the reallocation of funds. Only shares made from the reserves are transferred to the shareholders. Second, there is no realization of profits, because when you're receiving the shares, it's not that you're buying them, you're not giving out the money. It's essentially free of cost. And secondly, the value of the shares also goes down by a little. Okay. Only when you share, when you kind of sell the shares to another shareholder or another party with, with a premium, then only the income is happening, then only the profit is being realized. But if Ranjan Pai is not selling these bonus shares to a third party or to another source, then there is no profit that is essentially happening. He is not realizing any income, right? Lastly, as I said, creation versus transfer of shares. There is no transfer of property also, because Ranjan Pai, if he sells it to another person, then only there is a transfer of property, right? Apart from these, nothing is happening. Okay, so it's a very neutral event. The government, sorry, the High Court of Karnataka calls it to be a neutral event, and hence, uh, it did not actually give rise to any type of assessee's wealth, and this was not supposed to come under section 56. So this is your particular case on Ranjan Pai. All right, does anybody have any questions? Anybody who has questions? Okay, okay, I'll give you a minute. Just so if you have any questions on section 56 on the case, just let me know. Okay, I'll give you a minute. Okay. Since nobody has a question, I'll just recap for you the section as well as the case so that you is easier for you to ascertain. Okay. Um, Firstly, the section on 56 is called income from other sources. After your income, most of us are salaried employees with businesses or some amount of income from house property. But what if there is a certain amount of income that does not fall under any of these head that would come under the residuary section, which is section 56, income from other sources. For example, income from savings, certain income that arises from lotteries, horse races, certain income that arises if you are um, getting gifts exceeding 50,000. So, all these instances give rise to income from other sources and you'll be taxed. Okay, taxed at whose hand? The person who's receiving certain income, right? Not the person who's giving it. So, you as a person getting the gift, you will be asked to pay the tax, right? In section 56, we also see certain sections like section 56 subclause 2, subclause 7, subclause 7a, 7b. All these three sections actually give you a certain amount of shadow into what the legislative intent on abuse of any type of tax provisions is. Most of these provisions are made so that people cannot, who are realizing certain income, cannot evade the tax. Okay, one of them being what I said, angel tax, sorry, angel funding. You receive a certain amount of funding from another company, or you receive just a investor know-how, because maybe the investor has confidence in your company, you would still be taxed. That certain angel taxation has now been abolished from 2024, and there is no angel taxation anymore, because obviously startup culture wants you have to kind of innovate the startup culture, and that's why the government has set a foot that we will not be taxing any of these um, angel funding received by startups. Moving on to the next part, which is our case, the Ranjan Pai case, PCIT versus Ranjan Pai. Very simple. The question was whether issuance of bonus shares actually led to income and whether it would fall under income from other sources, right? Looking at issuance of bonus shares are issued from the reserves of a company, from any type of profits of the company. It is converted into shares and then given to the existing shareholders at free of cost. So, as Ranjan Pai is a shareholder who receives these shares free of cost, he does not pay any amount, he does not get any new amount. But when he sells these shares, he might realize a certain amount of profit or income. But unless and until that particular event of him selling of the shares to another person arises, there is no income that is being realized by Ranjan Pai, right? So what happens here is that the court scrutinizes this issuance of bonus shares on two lines. Firstly, section 56 subclause 7, and whether there is a creation of shares or transfer of shares. Here, the court sees that there is creation of shares, but there is no transfer of shares. And secondly, it looks at it as there is no transfer of property. It looks at it as mere reallocation of funds of the company to its shareholders. Secondly, there is no accrued benefit also, because when you are receiving the amounts from these companies from issuance of bonus of shares, the money of the share money does not go up. A lot of times it goes down. So essentially, you are also not realizing income from that particular event. So accordingly, this would not fall under section 56, income from other sources, right? However, if we look at a separate scenario where Dr. Ranjan Pai is selling off these shares at a premium to another person, that is transfer of property that will give rise to capital gains, right? So this is essentially what income from other sources actually implies. All right. Um, Yes. So I will just suggest you to go through your reading material, and if you have any questions, you can come back to me or come back to sir also, obviously. But is there any other questions on any other overall case section, even the questions that we discussed previously? Because this is it for the this session. We had a very small portion that was supposed to be done, just one section and just one case. Income from other sources is a very small part. The part from tax evasion that will start probably after, no, not the next section, after the next session, I think session on tax avoidance and the general corporate income slab. Those sections sessions will actually help you understand more on tax evasion, especially what Asha was talking about. So we'll talk about that in those sections. And yes, so this is what we had for today's session. Any other questions? Anything related to the work, related to your classes?
Ma'am, one thing I wish to ask.
Yes.
Income tax classes is income tax chapters or law is very tough to understand for me. What can I do for easy understanding of that?
I did not understand actually.
It is I am finding very difficult to understand the sections and other things of Income Tax Act, particularly Income Tax Act provisions like 220 plus 224 or section 56 income from other sources like that. So what can I do so that I can be good at income tax?
I mean, the first and foremost thing that comes to my mind is just going through the basics first. If you are having a lot of trouble, then just probably go through Sir's introductions 2 or 3 times. It will just help you understand what he's saying. Then go through the reading materials. Even if you don't understand the reading materials, I think the basic structures and everything you can easily understand from any book also. If you want to go through a simple book or something, I would not recommend a book, because the legal point of view are mostly absent in most books, because they always take a very CA perspective, chartered accountancy perspective. So when you're taking a chartered accountancy perspective, it will be very different from what a legal person would do. Secondly, I think you can go through maybe some YouTube videos if you want, if that helps you. That's a very, if you want to start off in a ground level, that's one place that I would suggest, that you can go through YouTube videos. If you have no other idea of what is going on in class, you can just go through that. But I would highly recommend that go through Sir's introductory class, because I remember he does it pretty well. Even when you are looking at all those um, sources as well as segments and everything. So yeah, I mean, that's one thing that I would suggest you to do. Or if you have problem understanding cases also, break it down, as in look at the facts first, understand the facts, what is going on. Next, go through the issue, go through the judgments, not necessarily the judgments also, you can go through the arguments of the counsel, the opposing counsel. That will also give you a certain amount of idea of what is going on. If nothing helps, you can use Notebook LM. Just put the whole um, judgment across the app, and then you can just ask it questions. You go through it, you ask it questions like, what is the facts of this case? Notebook LM will give you like a summarized version of the facts. That's one thing that I can say you can do. Yeah. Anything else, guys? Okay. This was a very small session because I just had one question, one section, and one case to do. Next session will be on 21st February. It will be taken by Sir himself. After that, tax avoidance sections are also going to be taken by Sir. I will start with your international taxation part. So, yes, if you have any questions, queries, you can always reach out to us. And thank you so much for attending. Thank you.
Thank you, ma'am.
Thank you.